VEDA Day 25. Good morning, Internet citizens. Phil Corley here again. Today, I'm going to talk a little bit about booms and busts, credit, and central banks. So, first, booms and busts have always been with us. If you look back into the history of finance, going all the way back to episodes such as the Dutch tulip mania, the South Sea bubble, Panic of 1870, Great Depression, or more recently the Great Recession, it seems that periodically, ever since we've been capable of measuring such things, humanity goes into some kind of a collective nosedive financially and economically, and we have pronounced periods of declining wealth, stagnating real wages, and general unhappiness economically. But in all cases, these busts were preceded by long, in some cases very long, periods of sustained boom times, in which we were all reassured by whatever the powers that were or are now, that the current boom was, that somehow this time was different, and that the current boom is sustainable, well-grounded, and that there are rational reasons for believing that it can continue forever. Until, of course, it doesn't. Now, over the years, there have been a number of competing theories, I guess, on the subject of what causes the busts. Usually the theories have been based on what is it that causes the downturn, and how can we keep the boom times going on perpetually. I take an alternative view. I believe that it is the booms that are fundamentally the problem, and the busts are the necessary correction to artificially inflated economic activity. Now, that doesn't mean that I'm advocating for economic stagnation over the long term. I guess what I'm advocating for is sustainable economic development, meaning economic development that can continue indefinitely without correction, which is different from a boom. And so what is a boom, and how do they happen? Well, if you look through all the booms that have preceded all of the busts in man's recorded history, they are all what I will call credit-fueled booms. Anyway, so what? Credit-fueled booms? They didn't have credit cards back in the Dutch tulip mania times. No, they did not. But they had the concept of credit. They had the concept of being able to borrow against assets or against your good name to be able to buy things in the promise that you would pay back later. And people were generally willing to lend so long as the asset being purchased with the borrowed money was perceived to be an asset that just could not go down in value. Like, for example, tulips at that time, and or investments in South Sea shipping, or technology stocks, or housing, or now, as seems to be the case, frankly, U.S. government bonds and other kinds of debt. So, well, where does the credit come from? Well, in times of antiquity, a lot of times it came from gold. It came literally from gold that suddenly entered into an economy from being discovered either overseas or, in the case of America, out west. And so this gold money entered the economy, and it entered it at a given point, because this was before the era of instant wire transfers. At best you had stagecoaches or horses or whatnot, and so you could have localized booms before the rest of the economy could absorb the sort of newly created money. And then people would borrow against that, and the contagion can spread more widely. And it's also more difficult to control at that point. But just like the Dutch tulip mania only happened in the Netherlands, it did not happen all over Europe, or the South Sea bubble was by and large concentrated to Anglophile investors. In our modern era, credit comes from only one place, really, I mean, yes, banks loan it, but where do they get the capacity to loan credit into existence? They get it from central banks. And right now, the entire planet operates under a central banking cartel regime. And so it's worth reminding us of what it is that a central bank can do. You know, central bank is often referred to as the banker's bank. In order to be federally chartered in the United States, for example, that means that you have to have an account with our central bank, the Federal Reserve. Now, you and I don't have accounts with the Federal Reserve, but Bank of America and Citibank and all those places have accounts with the Federal Reserve. And they're just computer accounts. It's not like any actual money or anything is in them. But the thing about these accounts is that they hold what's called reserves. That's why the Federal Reserve is called the Federal Reserve. So the money that is held in these accounts are called reserves, and they function essentially as base money, as the final method of payment for goods and services in our economy. And what I mean by that is no matter what you do, in the long term, you know, if you buy a car, okay, if you buy a car on credit, then, you know, you get credit from your bank. Well, your bank says, okay, to the bank of the dealership, here's some money. But where do those things ultimately get settled? After all of the canceling back and forth and ins and outs done, they get settled on net with the exchange of reserve balances at the Fed. Now, historically, these reserve balances have been pretty low, you know, maybe $40 or $50 billion, because, you know, we have advanced computerized clearinghouse systems. And with an advanced computerized clearinghouse system, then the banks don't have to move reserves back and forth, you know, for every one of us that buys a car or some big piece of item on credit or even mortgages. No, they only have to move things back and forth sort of on net between one another. So, you know, on a daily basis, you know, the sort of banks settle up on net between each other. And so you don't really see large movements in this amount. And there's a minimum amount of reserves that are required, they're called required reserves, by the Fed as a basis of the percentage of deposits out there. But this amount of reserves is very small, or had been very small for all of the history of 100-year history of the Fed until 2008. Since 2008, these reserves have ballooned from about $40 billion to, well, now close to $2 trillion. Yes, you heard me right. They went from 40 billion to now sitting around 1,900 billion. Well, if that's base money, if that's the final payment for goods and services, where did it come from? Well, the answer is that someone at the Federal Reserve's open market desk typed in a number into a computer, and those funds came into existence, and they were used to purchase things from the banks, you know, things like mortgage-backed securities or T-bills, usually T-bonds now, and then the proceeds, so the means by which the Federal Reserve purchased those security instruments, was by making deposits into those banks' reserve accounts with the Fed. So it would be kind of like if you said, you know what, you know, you have a friend named Jim, you say, you know what, Jim, I really want your car. Jim's like, well, fine, you can have it for $15,000. And you say, well, okay, just a moment. And if you were able to pull up a computer and open up Jim's account and say, add money, type in 15,000 and hit return, then Jim would have that $15,000 in his account. He could look and say, yep, I got that $15,000, here's my car. That would be pretty neat if you could just grant people any money, anyone you wanted. You could just grant the money in exchange for what you're buying. But that essentially is how the Federal Reserve works. The interesting part is that it just doesn't do this with anyone. Turns out that there's only, I forget the exact number. It used to be 19, but some of those firms have gone have gone bankrupt since then. So I want to say that it's some number greater than 10 and smaller than 20. These are called primary dealers, and these are the only people that the Fed actually directly credits their accounts with. There are such wonderful names as Goldman Sachs, for example. Now, you might say, if these banks know that the Fed can just type keys into a computer and make money appear in their accounts, then perhaps they might try to gouge the Fed for what it is that they're selling them for. I mean, after all, it's not like the Fed needs the money, right? They're just trying to buy a certain amount. So that in fact is what happens, and so these banks get to benefit in an outsized way by front running the Fed, essentially, by realizing, because the Fed's pretty transparent about these things, what things the Fed are going to want to buy, and then buying them, as they can at discount prices, and then reselling at a premium to the Fed. It's a pretty good racket if you can get in on it, but it's the fundamental core of the banking cartel in America, and it is a cartel. And with the Fed as the enforcement arm. So my argument is that it is this exact power. It is the power of the Fed, of people, employees at the Fed, to open up a computer and type any amount of money that they want into the computer, any number they want, hit enter, and have that money now spring into existence that is, in modern times, the cause of all booms and busts, ever since 1913. Because now, with modern technology, you don't have the problem of localized booms and busts like you had in the old gold economy. You could only have new money created now because the Fed types it in. I mean, yes, new gold is mined into existence, new other commodities come into existence, but their dollar value compared to the amount of money that the Fed's creating every year is really small. Now, some have said, well, Bill, this is all crap. So what if the Fed has created, $2 trillion of new money? If what you're saying is right, well, why haven't prices tripled? And, my facile answer is just wait. But the more complex answer is that all of that money that's been created has been sitting as reserve balances. Remember, I said that typically the banks only kept about $40 billion in reserves in aggregate, and they lent the rest out. Well, they're not lending right now at the rate that they are legally entitled to. So most of this money that the Fed has created has ended up in reserve balances. The equivalent, honestly, for banks of shoving the money under a mattress. And there's now almost $2 trillion of bank mattress money. And so that is basically the only thing that's keeping inflation expectations muted, if you will, at the time. But it has other effects. It has other follow-on effects, because what is it that the banks are exchanging with the Fed for this liquidity which they are storing in their excess reserves? They are exchanging treasury bonds and mortgage-backed securities, by and large. And this is an example of the Federal Reserve directly injecting, if you will, credit into these markets because of a misguided belief that if you only make it cheaper to borrow, the economy will prosper. Now, I'm already at 13 minutes, so I've already said too much. So I'm going to continue a little bit of this conversation tomorrow, I think. But I'll leave you with this. Number one, if this is of interest to you all at all, click the subscribe button down there. Number two, leave comments. If you have a question, if you think I'm full of crap, if you want to hear me talk about something in particular, if you want to challenge a particular point that I'm making, do so in the comments below. And I promise you, I will respond, and then I will make a response video. And with that, I'm out. So have a great day, and be kind to one another. Bye.